Grab has recently been the hottest stock on X. Everyone is talking about it. Everyone is looking into it. And it's not just Grab, but it's a lot of different stocks, growth stocks mainly. They've been getting a lot of popularity as of recent, as a lot of people are trying to find the next Hims and Hers Health, the next whatever. SoFi is starting to go up. A lot of those companies are starting to go up. They've been dead for 4 or 5 years. And they recently been coming back to life. And a lot of people are just looking for the next one. And a lot of people believe Grab could be the next Hims and Hers, or it could be some kind of Tempest.ai, 150, 200% kind of move. So I'm going to analyze the stock and talk about it. There's a lot of hype, a lot of different stories. A lot of you guys can agree with me as a technical analyst that this is a very bullish breakout on the stock. So I'm going to look into it, let you know if this is just hype, it's all hyped up, and maybe it's not worth an investment, or maybe it's actually an amazing company that's in its early stages and it's going to be an amazing investment for the long term. I'm going to do my best to analyze it. So I really hope you enjoy it. For Grab, it's being labeled as the Uber of Southeast Asia, and they have something called a super app because they don't only have deliveries and ride sharing, they also have a financial services app, which I found very interesting, and they have all of them within one app, one ecosystem, and they call it a super app, and it's a beautiful business model. A lot of popular companies are owners of Grab, being Uber, which is a stock that I own. Around 13.7% of Grab is owned by Uber. I thought it was 27%, but after looking at the numbers, it was only 13.7%. Toyota Motors also owns 5.7%, and they recently raised their stake in the company. We look at deliveries. This is their largest division, which was surprising to me because Uber in the United States, they have ride sharing as their largest division. For Grab, it's actually deliveries. And deliveries is still growing strong, around 16% year on year. GMV is still growing strong, 16% year on year. EBITDA is kicking in like never before, massive profitability. The company wasn't really too profitable until recently, and they've been expanding EBITDA margins 60% year on year. This is massive, massive growth for the company. We look at the market share as of 2023. This is the only report I found in Singapore. They have 63% market share for delivery. For Indonesia, they have a 50% market share. Malaysia, 65% market share. Vietnam, 47% market share. Philippines, 61% market share. And it's not bad. I have to admit, guys, it's not bad at all. And I talked with a lot of people that live in those countries in my own investment group and on X. And they told me that this is their app of choice. There's many different apps, but they love using Grab, and everyone loves using Grab. And it's a beautiful business model. Their total market share amongst everything they provide is estimated to be 54%, which is pretty amazing for the company. If we look at mobility, which is a ride sharing app, is growing faster than deliveries, 20% year on year on revenues. EBITDA is growing 18% year on year. Still massive, massive growth. And I believe the growth in mobility could be amazing. And this is from the annual report. And it shows you mainly in terms of an example of one ride. So if someone pays $13 for a ride, how much would Grab get on the bottom line in terms of revenues? So out of $13 that the customers pays for a ride, the current take rate for Grab is only 60 cents. This is nothing. I mean, nothing. Out of $13, they only take 60 cents. So they were not too focused on profitability in the beginning to gain market share, do many different things. This is what Uber did. And a lot of people, they made fun of Uber. They call it a money-losing company, while it was losing money by choice to attract a lot of people, gain popularity, gain market share. And now the company is starting to focus on profitability. And if out of $13, they're only taking 60 cents, and it could easily be $1, $1.25. If it just doubles to $1.20, that could be insane for the profitability of the company. So looking at that alone, I still see massive potential in terms of profitability growth for Grab, which is the main story. I believe revenues will likely continue growing 20%, but it's mainly in terms of profitable growth from here on out. Now, looking at the market share of the ride-sharing apps, I could not find any recent data The latest one was in 2021. But as you look in the blue, they have a massive market share in terms of the ride-hailing app. And unlike Uber in the United States, they're not facing too much autonomous vehicle competition from Tesla, at least not yet. But so far, they're not facing any kind of threat or competition in their countries from autonomous vehicles and all these kind of things. So it's very well positioned, especially amongst the demographics over there. So demographics are mostly good in those countries. Now we look at something very interesting that they have is they have a financial services platform within Grab, and it's growing 38% year on year. In terms of bank deposit, it tripled to around $1 billion in terms of consumer deposits. And this is a underserved area over there. And they've been profiting from it. And it's been amazing for the company. And I don't want to read the entire annual report to you, but I just want to highlight a very good point for the financial services platform. And the way they benefit from it is they have their drivers. They're paying their drivers, and they also have data from the merchants. So they have data from the merchants, from the stores, on how much money they make, but they also have the data from the drivers on how much money they make, and they have a wide network of merchants and drivers, so they can easily give them financial offerings from their services platform. If they want to do bank deposits, they want to deposit the money in a high-yield savings account that they earned from Grab. If they want to get a loan, they already have the data. They already have the network. So they don't even have to advertise to their drivers. They're already in the ecosystem. They don't have to advertise to their merchants. They're already in the ecosystem. And they can cross-sell them all kind of loans. So this is a very profitable business model. Maybe not right now, but over the long term, it could be extremely, extremely profitable for the company. But there's a lot of risks with this investment. The first one is share dilution. There was massive share dilution with the company, and it's been really crazy. But the company was unprofitable before now, and it's now finally turning profitable. They used to lose 35 cents in 2022. Now in 2025, they're expected to make 4 cents in earnings per share. Massive improvement, 9 cents, 3 cents. Now it's going to be positive 4 cents. So this is a massive, massive improvement. They're even going to be profitable this quarter. They were losing 1 to 2 cents in the last 2 quarters. The last quarter, they made around 1 cent. And this one, which I believe they report on Wednesday today, around 7 or 8 p.m., they're expected to make around 1 cent in earnings per share. So that's a massive improvement for the company. And I believe dilution will lessen over time. It's not going to be as dilutive as it used to be. Okay, now looking at the valuation is also very scary. It's trading at 187 times earnings. 187 times earnings is extremely, extremely overvalued for the stock, especially for value investors, as I talked about in my video on Sunday. 187 times earnings. It's just extremely overvalued. But I want to highlight a point, and this is a point that I made in my Sunday video titled The Biggest Mistake Value Investors Make, mainly with valuing growth stocks, is if you look at a company like Grab. Grab is still in its early stages of the business cycle. The company is still taking market share, still growing, still reinvesting in itself. So out of $716 million in revenue, $97 million went to research and development for them to try to find a new product, try to, improve the business, try to do something about it, find something new. 97 million went to research and development, which has led to a profit for the period of only 15 million. Now, if the company decided to cut research and development by only 15%, the profit for the period would go from 15 million to 30 million. So this alone, if they annualize it, this alone would take the PE from 187 times to around 90 times. This would cut the PE in half. 90 times might sound expensive, but the company is expected to grow 267% in earnings per share in 2025, 146% in 2026, 95% in 2027. So my point is that the company is not too profitable because it's choosing to do so, because they're reinvesting in themselves. It helps them reduce taxes, and it just helps them for growth over the long term. So if they wanted to trade at 90 or even 50 times earnings, they can cut research and development by 20, 30%. They would trade at 50 times earnings, and they would still grow 267% earnings per share, which would be massive, massive growth. And I know such growth sounds scary for the company, but it's just turned profitable. Their net margins are like 2%. and long term they could be up to 20%. So that's why those gross numbers, they look bigger than they are. Like if their net margins, they go from 2% to 4%, this is 100% growth, excluding revenue, excluding everything else. So this is how I would look at it. But 267% is a little bit high, I have to admit. And if we look at their record in terms of meeting the estimates, they beat the estimate 7 times, and they only missed once. So they have a very good record of actually beating the estimates, and they only missed it 1 time, which gives those estimates a much higher likelihood of them becoming a reality. And for me, if I wanted to value Grab, I would say again, before I continue, that this is an extremely speculative investment. It just turned profitable, and it's just very speculative in general. So if you decide to buy the stock, I don't believe you should put your entire portfolio into stock, and it should only be a small position as a speculative investment. If it does work out, if they do meet the estimate, you could make a lot of money. If not, then you could lose a little bit and move on. But the way I would look at Grab, if they were able to achieve those numbers, and because the company is so young, I believe they could easily able to achieve those numbers. And we assume that the company goes into 2026, okay, and it trades at its 2027 PE ratio of around 50 times. Now, the company right now is trading at 187 times. I'm taking a massive multiple contraction, and I'm taking it from 187 times to 50 times. This is a massive, massive contraction in the multiple. So in 2026, we assume that we're right now in 2026. The estimate is still 21 cents for 2027, and they trade at 50 times their forward PE ratio, price to earnings ratio, of around 50 times. So we take 21 cents, we time it by 50 times, and I believe 50 times is possible because they could likely keep growing earnings per share out 20, 30, 40% after growing 90% in 2027 for many years to come. So they're expected to grow 95%. So after that, they should grow 30, 40%, in my opinion. And if they were able to do that, 50 times earnings is not expensive for the company. Okay, now we take it times 50 times earnings. This is $10.50 per share. The current stock right now is trading at $5.30 per share. You get around 98% on the upside from now to like mid 2026. So this is over 100% on the upside in a year and a half. If it does beat on the estimates, or if they do even meet the estimate without beating on them, they beat 7 times and they only missed 1. So if they just match the estimates and the PE goes from 187 times to 50 times, you can still make up to 100% in a year and a half. Now, I get that this is a very speculative investment, and I always try to tell you guys that stuff. But in my opinion, if you're looking for something that's speculative, I believe it's worth the risk reward. I like the company. I see a lot of potential if they do meet on the estimates. If they don't meet on the estimates, the stock's going way down. And I just did my best to value it. It wasn't easy to value, but I did my best as always. So it wasn't financial advice, and I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.